Hey everyone, how are you doing today? As mentioned in the daily financial news, we are bringing on the legend, Jonathan Twomley. How you doing, sir? And if you're following along, folks, the first time he was wonderful and a legend. Number two, he was wonderful, and now he's just a legend. So I'm having fun
Get
this
all the
morning.
conversations, right?
Yeah, I like having fun. So hey, Jonathan, what I want to talk about today is a unintended consequence or a side effect or whatever you want to call it that very, very few people are looking at, right? A lot of people have been wrapped around the axle around all of these proposed tax changes. And I think some of them are coming in some form or the other. I don't want to talk about that here, right? Like, is it 39% or 35% or, any of that? I just want to talk about what I think is going to be the outcome next year is transaction volume in multifamily, commercial multifamily, and residential. I believe the natural order or the natural transactions are going to slow down dramatically because, again, investors will be frozen, right? I, for one, have been purposely buying residential single family homes with the intention and declared on this channel to 1031 in about 2023 or 2024. It's a process I did in 08. I wanted to do again, but if it goes away, I won't trade up. I won't sell. I will just hold. And there'll be 30 or 40 less affordable single family houses on the market. So, and I think that's going to happen across the board. So I want to talk to somebody who's in the other side, the commercial side, and see what you think.
Well, yeah. I mean, I think if it's pretty simple. If it becomes too expensive to sell, people aren't going to sell,
Exactly.
right?
It's just,
Yeah.
okay, I'll keep it.
I mean, it's going to certainly change people's behavior, right?
Exactly.
If you change from one set of rules to another set of rules, then there's going to be a time of adjustment. I mean, I think probably it will be shorter. It will be short term because in that transition period of like people's strategy, right?
Mhm.
So if your strategy was like, buy, rehab, refinance, and then sell in 1031,
Mhm.
like, and you've already done the rehab and the refi, and now you've got a big, you're going to have a problem with your tax bill,
Yeah.
when you sell and you have to repay the mortgage. People who are in that situation are just going to hold,
They
right?
can't.
Until
Again, I want people to realize what you just said, right? Let's just say you buy it at 10 million, you spend 3 million on the rehab, you're now into it, I don't know, 13, you go get money out. You have no money in the deal or very little.
yeah,
Then you go to sell and the 1031's gone. You can't pay back the mortgage, right? Without writing a
well,
check.
or you can pay back the mortgage, but you can't pay your tax then, right?
Yeah,
So
you can't
like
pay the
all
tax.
the
Yeah.
money's gonna all the money's gonna go into paying the mortgage, but you're still gonna have a tax bill, right?
Absolutely.
And so
Yeah.
so people who are in that situation are going to have to just
Hold.
refinance the old debt at the whatever the principal balance is
Mm-hmm.
and just hold it because and until they kind of work, over time, work through enough appreciation and where they now can
Yeah.
sell it eventually and be able to pay the tax. But I think what's going to, and then like, the other group of people will not be doing the refis
Mm-hmm.
because they are thinking like, well, if I'm not going to be able to do 1031, then I'm going to be stuck. So I definitely think that, if people's behavior will change for sure, if the
Yeah.
rules change and that those folks who were caught in the middle between one set of rules when they buy and one set of rules when they're looking to sell are just a lot of those people just won't be in a position to sell.
Yeah, they
So they
can't. They fundamentally can't sell. So there were planned transactions. And again, my little world is small, but this is happening to hundreds or thousands of individuals. You buy under one set of rules with a plan, and then they kick the board over and the different rules. You've got to change. Your exit's different. And most, if not all of them, will just simply hold because
but
that's the most efficient thing to do.
and I also think that this may this may force a change in strategy kind of across the board, which is that people are really going to be buying for cash flow,
Oh, I
right?
agree. I think that
Not,
changes also.
not be
Yes.
buying, yeah, not be buying for appreciation because the appreciation is going to be too expensive, right?
I'm
So
glad you brought that up.
yeah, so they're going to be buying for cash flow, which I think is going to imply some kind of cap rate decompression as well,
You would
because
hope.
you know if that's going to be your return and you can't count on that back end, either because it the change in the rules kind of just makes less appreciation possible, or because, well, look, you might have paper appreciation, but you can't capture it because you can't sell. You got to think about that.
Yeah.
Then people are going to think, well, I've got to get my return some way, some other way. That's through cash flow on the property, and that it only makes sense. It can't make any money buying at a 4 cap, right?
No, exactly. Exactly.
So cap rates have got to go up, right? They're just going to have to go up.
I think decompression is the right word. I think deals get evaluated very differently next year this time. And I think, I'll say it, not you, but I think there's a lot of rookie syndicators out there who will keep operating under yesterday's rules, not realizing that tomorrow is different. And they're going to hurt a lot of equity. They're going to hurt a lot of their investors.
Yeah. I mean, well, we'll see how this shakes out, right? I mean, we've already talked about whether 1031 is going to survive or not.
Yeah.
I mean, I'm of the view that I think it will. I don't think it's going to get through.
Okay.
Just because of this issue, because so many people, because it's baked in so deeply to the way things are done. The only way they could get rid of it is to say, like, hey, we're going to phase it out over 10 years. And otherwise, it would just be too much of a shock to the system. And you have to believe that the real estate industry is going to put a full court press on Congress to prevent this change from happening. So I think the chances are pretty.
You and I disagree on this one. I think they're going to do it. I think they do have to negotiate up from the $500,000 limit. I think they're going to move it to $1 million. But that'll be the only thing they give. We'll see. But again, I think no matter what happens, there's like a triple whammy, right? Capital gains going up, stepped up basis, and the 1031. I think that's a hodgepodge that some of that gets through. And again, I think the outcome is less existing owners sell. They just hold longer, right? The average hold time goes up. I'm not saying that's a bad thing. I'm just saying it's a thing.
Yeah. I mean, it's going to be, if that plays out the way that you say it, the way that you think it will, it has already become really, really difficult for the small investor to buy property, right?
Yeah.
Just with what's happened over the last, 5 years in particular, it has become increasingly difficult. And across the board, it has just become this low interest rate environment has created a situation which is very, very difficult for people to build like cash flow and to get compounding from their investments. Even like the stock market has gone crazy, so people have made money, but it can always go in reverse. Same thing with the real estate, can always go in reverse. The only thing you can really count on is the cash flow, and that has been just devastated. Bond yields have been devastated, real estate yields have been devastated, everything's been devastated, and it's just made it really, really difficult for people to make money kind of like the good old-fashioned way, right? Yeah. And so and the changes in the industry have made it also just hard for people to get their hands on property, even if they're willing to take you could still sort of play out a scenario where if you're thinking like, hey, I'm 30 years old, I'm going to buy an investment property. I know the cap rate is going to be 4, but I'm just going to hold it forever. And eventually, this is going to be producing 15, 20% a year for me. And I'm thinking about 30 years from now, you can still sort of envision that, but it just has become really, really difficult to buy property. And it's become, and this may make it even more difficult. This is just like adding another obstacle. If you have less property on the market, it's just going to make the prices rise even more, put more things out of reach for folks. And also frankly, for the, even homeowners, like people who just want to own a house without just to live in.
I'm glad you went there, because I see the dominoes and they're falling. That's just how this works out in my head. It's just a series of dominoes that are falling. And I think what happens is the affordable home, the mythical affordable home, which is where I buy, and it's where cash flow exists, right? I think that almost becomes a unicorn, because not only do we have one rental at a time kind of mantra, but you have now deep outside forces coming in. You have Redfins and Zillows and Wall Street and insurance companies proving that single family homes could be lumped together. Not only now you have builders that are doing build for rent and selling entire communities to Wall Street. The affordable home is going to go up. It's going to become harder to get. So get off your butt and get on the property ladder right now.
Yeah. Well, I mean, listen, that is a really interesting and important point that, the institutional buyers, and this is not just for, this is for multifamily too, not just single family.
No, agreed.
Institutional buyers are getting bigger and bigger. A bigger chunk of multifamily is coming under the control of very, very large funds. And the market now, you couldn't say the market is consolidated because those big funds still only control maybe 30% of the entire market, but
the trend
is, and there's some properties they will never touch, right? I mean, there's some areas they're never going to go to, but all of the, the hot markets where, most people are looking to invest are also the targets of those institutional investors.
No doubt.
And you're going to be increasingly competing with them as, as there are fewer and fewer opportunities to buy big deals, they're going to start poaching down below, and they're going to start like this. And they've already for years, institutional investors were like, how can we possibly own single family homes at scale? There's no way we can do this. Can't manage them. They've proven that they can now.
Exactly. That was a game changer. Exactly.
And so since they can, well, what's the difference with multifamily? It used to be the institutions were like, well, it's too small for us. Now they're like, well, we'll just go roll up 50 small ones, right? And so, and now it's big enough for us to buy. And it's going to be very, very hard for folks like you and me to compete with that, right? So, and I'm even seeing, frankly, amongst syndicator friends, a lot of people are raising funds, right? And it's very easy to raise funds right now. People are, 5 years ago it was impossible. Nobody wanted to invest in a fund. Now funds are everywhere. And so people are, big piles of money, even from some smaller people, some smaller, they're not institutional level investors, but now they've got $50 or $100 million in that they can use to buy more multifamily, just going to drive the price up even more. So,
yeah. So folks, I've said this many times on my channel. I think the single family home is the best asset to buy for the next 6 to 18 months. You get artificially low rates because what the Fed is doing, you buy ahead, you have inflation coming in value and rent. And, if you do it, in a couple of years, it's going to be more expensive. That's just how it's going to go.
And listen, with the single family homes too, you get that 30-year mortgage.
30-year money.
You have 30-year money. With the commercial property, you're looking at, generally speaking, the best you're going to get is 10 years. There are some loan programs go a little bit longer, but you're pretty much looking at a 10-year note at the longest, right? And oftentimes you can't even get 30-year amortization. If you're dealing with a small bank, you're going to get a 5-year note and 20 or 25-year amortization. If you have, well, obviously that it's good. You're building up your equity a lot faster, but you don't have the cash flow.
Correct.
You buy a, sub 5-unit building for or less with a residential loan, crazy low interest rates, and lock it in for 30 years. Like you're gonna be very happy you did that 30 years.
I'm glad you said that, because again, I've been telling people 5 years from now, you are going to be smiling when you've got a 3.5, 4% loan and they're 6.5, 7. It's going to be wonderful. So go ahead.
No, I mean, nothing to add to that. Just
just go, get going.
I mean, it's a good asset to own. So
very cool. Well, Jonathan, thank you for your time today. These have been 3 great episodes, and you are wonderful and a legend. Just wanted to let you know that. Thanks, buddy.